Let's welcome in our next guest, Chintan Haria, Fund Manager at ICICI Prudential. Chintan, good morning. What do you think will be the impact? How have things gone in the last 20-25 days? Do you expect situation to improve and the wealth effect may not be as high as the initial fears were?
So if we look at whatever feedback we were getting on the ground, clearly things had slowed down in the first 2 weeks and probably they'll continue for the next 2 to 3 weeks. However, once the liquidity is back in the system, once the people are able to withdraw and the business as usual happens, maybe after the first quarter of 2017 calendar year, we should see business coming back to normal. Currently, of course, there is a slowdown across whatever we are hearing on the ground, and to that will get reflected in the numbers that we see in terms of the third quarter numbers as and when they come out.
Right. What do you think can be the impact on high PE stocks? High PE stocks generally had a tendency to deliver consistent numbers. A lot of them were from the consumer staple names, which get impacted by cash and the amount of cash purchases. Do you think they'll have a big impact, or it'll just be a knee-jerk reaction?
If you look at it, the low unit consumption may not have such a large negative impact. It's the high value, let's say discretionary expenditure, which will probably see a downtick. And so maybe a 4 lakh, 5 lakh rupee car may not get hit as much as probably a 20 lakh rupee car. But if you look at the staples, it is not going to get impacted too much. It is going to be just a one quarter phenomena. But the valuations of consumer staples is not something which is very attractive. So to that extent, in the defensive pack, that is information technology, pharma and consumer, still prefer information technology and pharma over the consumer pack, because information technology, because of the US elections and the noise surrounding it and the lack of growth, are available at a far lesser PE than even Nifty today. And that makes information technology stocks very attractive to us. And if you look at pharma, the domestic growth is something which is certain. Internationally, we had issues relating to FDA with most of our large companies, which seem to be sorting one after another. So overall, with the defensive pack, which is information technology, pharma and consumer, we clearly prefer information technology and pharma. While consumer names probably one can bite into once this correction happens, but probably the third quarter results will give us a better entry point is what our belief is.
Right. As far as financial inclusion is concerned or financial savings are concerned, do you expect mutual fund industry to be a big beneficiary? Now that physical assets like real estate, gold may not be this attractive in FY18 after this entire demonetization impact is being absorbed, the new savings would come much more into the mutual fund space?
So actually, if you look at it, that change has been happening since 2013. Since 2013, practically the gold has not risen, real estate has been stagnant, and the financial savings are finding their way into mutual funds, and mutual funds have seen a good growth in the last 3 years. And we expect this to only continue over the next many years, because in India, the mutual fund industry is very small relative to the banking industry, and at some point of time, if you look at the global comparisons, the mutual fund industry is much higher as percentage of a banking industry in a global average. So yes, with increased financial savings and now more financial savings happening, mutual funds will definitely benefit going forward as much as they've benefited in the last 3 years. And with this demonetization, almost 12 lakh to 13 lakh crore is expected to come into banks. And with interest rates coming down, there is a high probability that mutual fund debt schemes will also start getting a lot of money. Historically, mutual funds in India were considered to be only for equity investors, and mutual fund equity investments were what was probably very, very well known. We are seeing a situation wherein mutual fund debt schemes are also getting very popular among the masses, and we are seeing a lot of traction in that as well. So to that extent, yes, mutual fund debt schemes will definitely benefit due to demonetization, and we see a lot of traction coming into it.
Right. As far as benefits of mutual funds are concerned, majority of it will be available only in FY18 because it will take 4, 5 months, 6 months for people to actually adjust to these changes.
I mean, we will probably see that happening in the first quarter of calendar year FY17 itself. So, I mean, if we are able to reach out to as many people and galvanize that financial savings into mutual fund, so yes, the entire impact will obviously be seen in FY18, but starting probably December 2016 itself, we will find traction happening in terms of galvanizing the financial savings into mutual fund debt schemes, as well as because we find equities very attractive over the next 2 years. Now with bond yields being lower, 10-year GSEC has gone down from 8.8 to 6.25. We believe that on a relative valuation basis, large cap equity is very, very attractive. And hence we will see flows coming into large cap equity and dynamic asset allocation products as well. So clearly equities as an asset class stands out. On the debt side, accrual as a category stands out. So we believe that over the next 3 years, mutual funds will see probably the AUMs growing significantly. And from an investor point of view, they have lots of benefits when they invest in mutual funds. So that should augur well. As we are able to reach more and more cities and penetrate deep into India, we believe that the growth in mutual funds is something which can happen over the next 3 to 4 years significantly relative to what has happened in the past 10 years.
Right. Just as we were speaking, we've got one high frequency consumer discretionary data where Maruti has declared numbers. The expectation was for a 2% growth number after demonetization, but the domestic sales are up 14%, 1.2 lakh units, and the overall sales are up close to about 12%. Exports continue to decline. They were expected to decline 8-9%, and that has been the case. Total sales up 12%, 1.35 lakh units. Chintan, I know you cannot comment on stocks, but Maruti, considering that it's more than 40-50% of market share, in such an environment where demonetization was expected to have a big wealth effect impact, at least in the month of November, delivering decent set of numbers, you would take that as a positive sign?
So like I said that if you are very strong in the band of say 4 lakh to 8 lakh rupee cars, there is unlikely that it is going to have an immediate impact, and after maybe December or Jan anyways things will stable out. It's probably the higher end market which may get affected, and yes, while the numbers which have come out are good, we still believe that the wealth effect in India is to play out over the next 3 to 5 years. If you look at our GDP, the per capita GDP is about $1,600. Just yesterday I was reading that we are going to be the largest market fourth largest market in terms of auto in the coming year. That's what one of this market survey predicts, and we will be overtaking Germany as the fourth largest market. So things in India are looking good because our per capita GDP is at the cusp of that J curve. Whenever a country has gone above that $1,600 GDP, things like auto ancillary and discretionary spend on the consumer side has only expanded. So while this demonetization may rock the boat for a quarter or two, in the long run things are looking good as far as all the sectors wherein the consumer spend is concerned. While valuations are something which we are not comfortable in, we would probably like valuations to correct before we enter in many of these consumer names in a big way.
Right. As far as, two-wheelers are concerned, that's much more price sensitive, much more rural focused. That's why those numbers would be interesting.
Yes, so as far as two-wheelers are concerned, there are many things which are playing out, right? The monsoons after 2 years were better than the previous 2 years. So monsoon effect is positive. If you look at on the government spending side with the 7th pay commission, plus if incremental money is going to be pumped in the rural economy by the government, then the two-wheeler segment again becomes attractive. So if you look at the two-wheeler numbers, they probably might not get as affected as we are thinking. Again, 1 quarter, 2 quarters is something which it may get impacted purely because people do not even have the money to actually go and buy. It's just the lack of liquidity which is probably going to affect. It's not the lack of buying power. So the buying power is there, the liquidity is not there. I think that situation should normalize in the next 2 quarters, and probably going into FY18, we will see two-wheeler sales also pick up, assuming rural these MSP hikes, good crop, and the government spending in the rural areas actually galvanizes the sales of two-wheelers in the FY18 and FY19.
Right. As a fund manager, you would definitely look at the broader market picture as well, or, what's happening with Sensex, the overall earnings, and not only the stocks that, you have in your portfolio. How would you look at Sensex earning as a fund manager? This big event has happened. Very difficult to assess, what will be the impact on the consensus earnings number in the next 6 months, how things progress. Every day things are changing. So next Q3 and Q4, do you believe markets have discounted that numbers can be a big miss or a big swing here and there?
So I guess one is the flow aspect, one is the numbers aspect. So we were always expecting numbers to improve in FY18 and FY19. FY17 was supposed to be a better year, but not as great as what probably FY18 and FY19 was going to be. And the major swing in market is going to be because of two factors, or two sectors rather. One is the banking, second is the metals, including oil. If you look at banking, the write-off sector which were happening in the last 3 years, they seem to be bottoming out. And with credit growth hopefully picking up over the next 2 years, banking can report much better numbers. So the delta in banking itself can be significant in terms of earnings growth, which the large cap indices can show. And if you look at metals also, FY11 to FY13, FY14, they showed significant amount of pain. FY15 was probably the peak of the pain. And going into FY16, 17, 18 and 19, the metal cycle which has gone for probably has had the worst cycle in the last 8-9 years, will probably is seeing a trough. If you look at the global investment, so if you look at US, Japan, Europe, China, India, everyone is now talking of infrastructure spend, everyone is now talking of fiscal stimulus on the part of the government, because monetary, apart from India, everywhere else the monetary mechanism as far as interest rate cut is over. So most of the governments are going to do fiscal spending, which is good for infra spending across the world, and that will help ultimately the metals. And if you look at what's happened in crude yesterday, the cut which OPEC, it was a long due cut, I believe, and crude will probably or should not probably sustain below 40 for long, because if crude sustains below 40 for long, then there is no investment happening in crude for long. And if no investment happens ultimately in 2 to 3 years time, given that the demand and supply mismatch in crude is not very significant, there may be a spike and we may again see crude going above 80, 90, which is not good for India. So on the earnings front, these two sectors, banking as well as commodities including crude, can actually swing in the positive territory significantly in FY18 and 19. So while FY17 will again be a slow year or a slower year than what we had expected, because the demonetization will have a marginal impact on large cap, it's the positive effect of banking and metals which will happen in FY18 and FY19, which will probably show us a 12 to 14% earnings growth in the next 2 years. And that augurs well for the large cap part of the market. The mid cap and small cap, as I would have probably earlier mentioned on your show, is something which is still at a 50% premium to large cap, while the fund flow or the amount of money which is chasing mid caps, which are in general illiquid, is significant, and that can have an effect of the mid caps and small caps remaining elevated for the next 2 years as well. We are probably not very comfortable with the valuations of some of the mid caps, and that's where picking the right stocks in the mid cap and small cap space is going to be of utmost importance. So as a general rule, large caps across sectors, sector by sector, are looking relatively much cheaper than mid and small cap, and hence in mid and small cap you'll have to be very choosy about what stocks you're buying. In general, mid caps look, mid and small cap is a bit expensive, while large cap funds are something which we favor a lot.
Right. So say if an investor was invested into the mid cap, small cap funds, what should be the strategy? Slowly and steadily new SIPs should be done in the large cap space, or a little bit of shift from the mid cap or high growth space should be towards the defensive side?
So that depends on the risk profile of the investor and what amount of allocation the investor has to equities in general. In India, if you look at it, only 2.5% of our overall savings are in equities, which is very low. And this number is only going to increase. So if an investor's allocation is already very high and the risk appetite is not as high, then probably the investor can look to systematically move out from mid and small cap over the next 2 years. But that is a very individual investor linked as far as risk profile and allocation is concerned. In general, incremental SIPs, so SIPs actually are normally meant for 10 years. So in 10 years, be it mid cap, large cap or small cap, it really does not matter. But if you look at incremental lump sum investment, we prefer large cap and dynamic asset allocation funds. While for SIP, all these three categories are fine, because in general SIP is something which you should sustain for at least 10 years, 15 years to see the full benefit of SIP happening. So I would encourage as many investors to start their SIPs if they have not already done, and see the wealth creation effect which SIPs can have over a long period of time.
Right, and also just for our viewers, every time people come and they say that, if you're not invested in the market, the recent correction is a good buying opportunity. As you said that, if SIPs are for 8 to 10 years, it really doesn't matter. So don't try and time the market. Just start a SIP, just make a new fresh start in your investments.
Yes, absolutely. As it is said that timing the market is not right, time in the market is important, and hence spending time in the market is very, very important. The good part is that at least as far as mutual fund flows are concerned, we see that our Indian investor has got very, very savvy. Whenever the markets are higher, we probably see them not investing as much. Whenever the markets are lower, they're investing. And unlike the 2007-8 cycle, wherein whenever the markets used to fall, we used to see redemptions. We are not seeing redemptions happening whenever the markets are falling. We are only seeing inflows. That's a good part. And yes, like you rightly mentioned, if an investor has not started, it is a good time to start. Whenever you start, probably 10 years down the line, 15 years down the line, it will show results. So the starting is important, and rather than watching market every day, just investing through systematic investment plan and probably letting your money grow over time. Without focusing too much on what's happening on market, because most of us unfortunately get attracted to the market when markets are very, very high, or markets are the valuations are expensive, because that's when most of us probably start speaking about equities as well. So generally on word of mouth, most of the people keep hearing about equity is doing well, and that's when they invest, and then the market falls and then they don't invest. So as a investor, for long-term systematic investment plan works very well. It helps create wealth for over a long period of time, and hence instead of worrying too much about what's happening, because events keep happening for the last 150 years or 100 years, we've seen US history, we've seen Indian history, events have kept happening, but the markets have kept growing higher. So to take advantage of rupee cost averaging, to take advantage of long-term wealth creation which equities provides, and equities as a tool is very good to beat inflation as well. And in the current environment where deposits are yielding lesser returns, interest rates in general are coming down, equities as an asset class, if one has the risk appetite and one gets the asset allocation right, can help create better wealth over a long period of time. And it is more sustainable if you do it via a systematic investment plan without worrying too much about the market.
In terms of choosing a fund is concerned, you mentioned about the 100-year history that US has or any other big developed market has. Even here in India, if you look at some of the funds, some of the big 3-4 big companies like ICICI, Reliance, maybe Birla, maybe HDFC, they have a decent history of 20 years. There has been a stickiness to the fund manager that has been there at the top. So even if somebody does research on the top 3-4, your Indian originated mutual funds, there is sufficient history now, unlike 2003 or 4.
Yes, we have a history of 20 years, 15 to 20 years, which is sufficient in our opinion. And the beauty about systematic investment plan is that as long as you choose the right fund house, which are systems and processes which are very good, if you see most of the large fund houses which have different schemes, if you can choose the right scheme, if you can choose, and choosing the right scheme means if you can have a diversified portfolio of 3 to 4 funds, you don't need more than 3 to 4 fund schemes. So if you have large cap, mid cap, a balanced category and a dynamic asset allocation category, these 4 are good enough in terms of SIP, and over a long periods of time, wealth can be created in these. So you don't need to have too many funds in your portfolio. Choose between the large cap, mid cap, balanced fund and dynamic asset allocation category. These 4, and if you have a SIP in these 4, it's something which can over a long period of time create good value. For lump sum investments, we always preferred dynamic asset allocation category, because as an investor, we don't know when we get as an investor, you may not know when the money comes to you. So it could be February 2015 when markets were at their peak. It could be March 2009 when markets were at their bottom. So dynamic asset allocation category takes care of that problem of the investor, wherein he gets lump sum money, he wants to invest in market, is not sure which fund, whether it's the right time or not. So dynamic asset allocation as a category, because they are very well invested when the markets are at their bottom or the valuations are attractive, and they are lesser invested when the markets are at the peak. They are actually ensuring that the investor's wealth is protected when the markets fall after they have invested at a high level, and they are participating when the markets are going up if they have invested at a low level. So from a lump sum investment point of view, like I mentioned, dynamic asset allocation is always the best bet as far as investor is concerned. On a ongoing basis, an investor can do SIP in any of the funds within the large cap, mid cap, and balance category, and that should augur well over a long period of time. Again, it's important for each investor to see the risk profile which suits that investor and the asset allocation of that investor. So if the investor gets these two metrics right, then one can invest without worrying about markets. So whenever the markets fall, you start worrying, that's not a good thing for you. It doesn't help in long-term wealth creation. Whenever the markets are falling, actually it's a good time to increase your investment in market. That's in general has helped most people to create wealth in the markets for long term.
Right. Chintan, very, very interesting. Hope to see you again soon, and hope our viewers learned a lot about investing and managing their wealth. That was a view coming in from ICICI Prudential Mutual.